We are living through an everything rally. It feels good, it feels permanent, and it feels like the growth is infinite. But look closely at the foundation beneath it. John Hussman, the legendary investor who successfully mapped the traps of 2000 and 2008, is raising the alarm on something far more dangerous than just a market dip. He is warning that the S&P 500 is currently sitting on the most extreme valuation bubble in a century, with the potential for a 60% collapse. This isn't about bad news, it's about the mathematical impossibility of current prices staying where they are. Most investors get distracted by the P/E ratio, but John Hussman looks at the clinical truth, the market cap to gross value added ratio. Think of GVA as the actual tangible economic meat produced by American corporations. It's what companies actually generate through real labor, innovation, and production, stripped of financial engineering, stock buybacks, and accounting tricks. When you compare this to the S&P 500, you see the most dangerous divergence in market history. The blue line, representing your total market value, is currently accelerating into the stratosphere, while the red line, the actual economic value, has barely budged. That widening chasm is the bubble. It isn't growth, it is pure speculative air. We are currently at valuation levels seen only twice before, right before the 1929 Great Depression and the 2000 dot-com bust. Hussman's data identifies this as a structural break, a moment where expectations have completely severed their tie to reality. Why are we so collectively blind to this? Why, with the data screaming at us, do we still feel the urge to push by? It's the liquidity trap. For over a decade, central banks have flooded the system with cheap capital. This didn't just inflate asset prices, it fundamentally distorted our internal financial compass. We have been Pavlovian trained to buy the dip. Every minor pullback, every 5% dip, was instantly rewarded by a fresh injection of liquidity. Investors stopped looking at intrinsic value and started looking at the policy, betting that the central bank would always have their back. But Hussman's metrics tell us that the game has fundamentally changed. When you reach these specific, extreme historical detachments from gross value added, buying the dip ceases to be an investment strategy. It transforms into a one-way ticket to holding a rapidly depreciating asset. We are currently being shepherded by a new kind of market participant, price-insensitive algorithms that only know how to chase momentum, paired with retail investors fueled purely by FOMO, the fear of missing out. This combination is dangerous because it ignores the mechanical reality of the bubble term. In every historical bubble, there is a point where the growth rate of speculative credit can no longer sustain the valuation. It hits a wall. And when that wall is hit, the reversal isn't a graceful decline, it is a waterfall event. It is a rapid, cascading liquidation where the algorithms trip over themselves to exit, leaving those who bought the dip holding the bag while the liquidity evaporates in real time. The safety net you think exists is part of the bubble too. If you understand the math, you stop being a passenger in someone else's crash. Legendary institutional investors, the smart money, are not sitting blindly in passive index funds waiting for the floor to fall out. They are currently executing a massive quiet rotation. They are aggressively trimming exposure to the most overvalued, crowded mega-cap tech stocks, the massive companies that are artificially carrying the index to record highs. They aren't doing this because they hate the companies, they're doing it because they understand the cost of overvaluation. They are pivoting into assets that actually produce real-world, tangible value. We're talking about high-utility commodities that act as inflation anchors, energy infrastructure projects that provide the backbone of our economy, and defensive hedges designed specifically to survive liquidity crunches. This is the classic smart money maneuver. They are methodically exiting the theater while the retail crowd is still standing on their chairs, cheering for an encore that the data says will never come. When the trap door eventually swings open, they won't be the ones left standing on the glass floor. They'll be holding the real assets that have survived the collapse. The question isn't whether the market will turn, it's whether you'll be holding paper promises or tangible wealth when it does. John Hussman's warning isn't just doom-mongering, it's a cold, hard call to analytical sanity. The market is not an infinite machine. Are you invested in companies that create actual, tangible value, or are you just betting on the continued inflation of a bubble? Drop a comment. Do you think we're seeing a structural top, or is this new era different? Hit subscribe for more data-driven macro analysis. Stay rational, stay analytical. We'll see you in the comments section.